to this training on spread and swap. My name is Zachary, and we're going to be discussing three main things inside of this video. First and foremost, what is spread? Secondly, what is swap? And thirdly, we're going to be discussing how spread and swap will affect your positions. So let's start off by talking about the spread. Spread is the difference between the price you may buy or sell at. And this is very, very, very important to realize, because if you're not factoring in the spread, what might happen sometimes is that your trade, even though it looks as if the price traded into or through your point of interest, maybe you put a limit order, perhaps you had a specific price level that you were looking at, and when you go back, it looked as if the market traded into or even slightly through your point of interest. If you didn't factor the spread, sometimes you're not going to get filled in your position. If we were to take a look at what I have planned out on the screen right now, a hypothetical entry at the 1.35750 price level on the US dollar Canadian. It was taking a look at the midpoint of this week's gap as of the time of this recording. And during the New York session, what we saw was the market traded up and through that particular price level, and then it has continued to move in the bearish direction. If we look at the high on the New York Open candle, it says 1.35760. So that is a 1 pip difference between where the limit order could have been set and the high on the candle that traded up and through that specific price level. Now, sometimes your broker is going to have very, very low spreads, and the average throughout the entirety of the day may only be 1 to 2 pips. It could be even less depending on your account type. But in this particular instance, if the spread was greater than 1 pip at the time that the market traded up and into that area, we can see that it was not there for very long. We came up, we traded through the 1.35750 price level, and then pretty much immediately traded away from it and had this break in the structure. If something like this happens and the spread was a little bit wider, you're not going to have the opportunity to actually get filled on a limit position, such as in this example. Now, the spread, you're already going to be familiar with it if you've taken any live or demo trades. It's that immediate drawdown that you face. When you press buy or you press sell, do you know how it immediately puts your trade into the negative? That is because of the spread. When we're looking at the trading view chart, it's only showing us one price. If you were to go on your broker, however, if you wanted to buy, you may be able to buy it right here, about 1.5 to 2 pips above the current market price. Whereas if you wanted to sell, you may be able to execute immediately at the price that would have been displayed on TradingView. So spread, very important. Specifically, you got to make sure that you're factoring it in when you are setting your limit orders, setting your stop loss, and even setting your take profits. If we were to look at this a little bit differently and say that the trade was set up like this, Okay, with the stop loss being set right here in that same example where the market traded up and into that particular price level, even though it looks like the market did not trade to where the stop loss would have been set in this hypothetical example, what could actually happen is the spread may be up here. And so you would have actually been taken out of that position if that was what you had planned and actually executed into the market. So spread is nothing to be afraid of, but you definitely need to be aware of it. And a good rule of thumb, anytime that you are planning out a position, whether you're looking for your potential entry, your potential target, your potential stop loss, of course, it does depend on what you're trading. But for Forex currency pairs, it's always a good idea to factor in whatever your broker's average spread is. So that may be 2 pips, it may be 3 pips, but factor that in when you're actually planning out your price point that you want to enter in, as well as your targets and your stop losses. If you're trading something like gold and silver or other commodities, the spread may be a little bit bigger. And then the same thing for the indices or even digital currencies like Bitcoin. You really just have to first and foremost take a look at what the spread says. And I'm going to show you an example right now in the form of an image so that you can have a better understanding of where you can actually see this information on your broker's platform. All right, what we've got up in front of us right now is the mobile MetaTrader 4 platform, and we can see under the USD CAD symbol, it says spread 12. This would be the equivalent of 1.2 pips on the US dollar Canadian pair. And we can see that displayed right here on this image. If you'll notice how there's 2 lines, one of them at the top and then one of them at the bottom. If we were to go and press buy, we would be getting our entry at the higher price. And then if we were to press sell, we would be taking our entry at the bottom price level, and that would be the cause of the position being in a immediate drawdown, the fact that spread exists. And it would be the exact same thing for us to consider if we were looking for a take profit level or a stop loss level. We always need to account for the difference between the price that we can buy and or sell. And the last thing that I'm going to share with you about spread, I did mention that it is very dependent on your platform that you are trading with. So just go and read through whatever information they're willing to provide you about how spread works on their platform, as well as the different account types that are available, because some account types have 0 spread. But because you have 0 spread, more often than not, you're going to pay a little bit more in commissions. There's also going to be a difference between a live and a demo account. So just make sure that you're taking all of that into consideration as you are progressing in your development. At this time, we are going to switch and discuss swap. The swap is a fee that you get charged for holding trades overnight or over the weekend. Traditionally, you're going to be charged a swap fee on pretty much every single account type that there is. Most demo platforms even have a very small swap fee factored in, but there is a pretty big difference. If we take a look at the photo that's up on the screen right now, this is a Euro USD demo screenshot of what swap fees would be involved with taking a trade on this specific currency pair. If you bring your attention down to the bottom where it says swap long and swap short, you'll notice that one of them is positive and one of them is negative. That's one of the really cool things about swap. Even though it applies to pretty much every single account type except Islamic ones, generally what you're going to find is that there will be specific things you can trade where you will actually get paid to hold onto your position into the new day or over the weekend. If you find something that offers you a positive swap, it will be displayed like this with just a number. And if it is a swap fee where you need to pay, it's going to have a negative. Now, I mentioned that this is a demo platform. If we were to switch to a real live account example, we can see that the swap long in this instance is actually a negative swap. And then your swap short is a positive one. So always take the swap into consideration because it can cause additional fees to be incurred within your position, but it can also grant you the possibility for even greater profits than you originally anticipated if you planned on doing some day trading or some swing trading with the intention of holding on to your position for longer than just a few moments or even within the span of a single day. The swap fee is going to come into play on pretty much anything that you can trade. With most digital currencies, it's always going to be a negative swap. When you're trading things like exotic currencies, sometimes the swap may be negative on both. Other times, like in this example with the US dollar, Japanese yen, you're going to find that it is a swap long, which means you will get paid for holding onto a buy position, but you will have to pay to hold onto your short. And all this information is made available to you from your broker, and the swap fees are going to vary depending on where you choose to trade. The last thing that I want to mention to you related to swap is that unless you are trading with a specific account type or a broker that advertises swap free trades, you are going to need to take this into account. The swap, it changes pretty much every single day. Sometimes your broker may charge a triple swap fee. That will generally happen on Wednesdays, where your swap fee for holding onto a position is 3 times greater than the numbers that are displayed. And that's caused because they basically factor in the weekend. So it's almost like they're charging you ahead of Saturday and Sunday. So you do need to take that into consideration. Like I mentioned, though, with how swap is calculated, it's at the end of the day really heavily dependent on where you choose to trade. But there are things that need to be taken into consideration on a more macro perspective. So the country's interest rates, for example, if one interest rate is greater than the other, such as in this example of the US dollar, Japanese yen, the interest rates for the US dollar are greater than the Japanese yen. The Japanese yen actually has a negative interest rate. And so that would be why the swap long is positive, because it makes more sense from a interest rate perspective to be long on the dollar, because you would be generating more income from holding on to dollars compared to trying to save money in the Japanese yen, since you would actually be paying interest rather than generating interest due to how the rates are currently set as of the time of this recording. The technical aspect, when you're actually looking at the charts, it should always come first and foremost. You don't want to be taking a trade solely based off of what the swap is saying, but it is just one of those nice little added benefits, especially if you do position yourself on a more long-term position. Having that extra benefit of getting paid for your position as each and every single day passes. If for whatever reason you have a difficult time finding the details related to the swap, what you can do on a mobile device, click on whatever it is that you're trading, and then go to details. And what it's going to do is it's going to bring you to a page that looks like this. If you are using a desktop version of the trading platform, then you can also right-click on the asset, choose specification, and it's going to bring up the details of the contract that you would be taking a position on. And you can see the swap long, you can see the swap short, you can also see if they do charge any 3-day swap. So all of that information is available to you if for whatever reason you cannot find it on your broker's frequently asked questions. That is going to be all for this training video. Now you know the things that you need to know related to spread, related to swap, and also knowing that these things need to be taken into consideration whenever you are taking a position in the markets.